Hello, this is Argel Silva, the Flash Lender, and this short video is part of my Home Buyers Education series. And today I'll be reviewing buying a home with an FHA loan. FHA is the Federal Housing Administration. This is a department that's part of the HUD, Housing and Urban Development Department of the federal government. It is not a bank, and they don't lend money directly to the public. What they do is insure loans to help lenders lower the risk and that way help families buy a house. People that have imperfect credit and limited savings for down payment and closing costs. With some preparation and planning, buying a home is possible. Some of the requirements that you will need to qualify for the FHA loan is a stable work history, which requires 2 years work history in the same type of education and hopefully with no gaps over 30 days. You can use Social Security income, retirement income, and even child support as long as you've been receiving it for at least 12 months and will continue receiving it for at least 3 years. You may also use self-employment income, and just be aware that any deductions that you report in your tax returns may lower your gross income and thus lower the amount of home you can qualify for. There are some credit requirements that you need to be aware of. With the FHA program, you may be able to purchase a home with at least a 580 FICO score, financing up to 96.5% of the loan, which requires a 3.5% down payment. Now, your interest rate may be higher with a lower FICO score, so a higher score is best. Now, if you have a less than 580 FICO score, you can still purchase a home, but it will require a 10% down payment. Now, let's review some of the sources for your down payment and closing costs. One of the ways that most people purchase a home is by putting money aside and saving it month to month. So savings is the first way to be able to cover that 3.5% to some of the closing costs, which in normal transactions is between 2 to 4% for closing costs. It varies depending on the time of the year, the amount of insurance that you got to get, and all those things, which may vary with your credit score and all that stuff. But just as general savings you can use to purchase the property, as well as a gift from a family member, a grant from a government agency. Even lenders can offer grants at some time, so make sure you ask your loan officer or ask me if we have those available. Down payment assistance programs are available from different programs, different agencies. They have different requirements. Some have no credit score requirements, or some have 580, some have 640, and so it varies from down payment assistance program to down payment assistance program. Most of them will cover from 3 to 5%, so make sure you find out which ones apply to you. You can also get a loan which is secured by real estate. Many of these down payment assistance programs are considered a loan that's secured by real estate. It covers 3 to 5%, and some of them may have a payment that you must pay every month. Some may not. It might be deferred for 10 years, and then you have to pay it at the end of 10 years by either refinancing your home or when you sell your home. You cannot use, with FHA loans, you cannot use mattress money, although there are guidelines that says that you can, but most likely they will require you to deposit that money into the bank account for at least 30 days and write a letter explaining where you got the money from. Another way to pay for the down payment and or closing costs is by getting a credit from your realtor, what I call a buyer broker rebate. And it varies from realtor to realtor. I know that there are online companies like Zillow and Redfin and even some big national real estate companies that will give back a certain percentage so that they can help you with the closing cost. So these are some of the ways that you can use. Another thing that you have to look at to qualify for the FHA program is debt ratios. Now this is very important because just like the FICO credit score is an easy way for a lender to look at your credit worthiness, debt ratios looks at your income and how you use your money. So a debt ratio is basically your liabilities or your monthly expenses over your monthly income. It says assets here, but it's really your monthly income. For example, if you make $7,500 a month and you have debts including your credit cards, car, home, student loans, maybe child support payments that you're making. Let's say it's $3,000, so you'll divide that $3,000 by $7,500, and your total debt income ratio is 40%. At this moment, FHA can qualify you with debt ratios up to 46.99% and a total debt ratio of 55%. If you have any questions on debt ratios, make sure you discuss these with your loan officer. There are maximum loan amounts for each type of loan. FHA has a single family loan at $420,680, although these change periodically, so keep an eye on that. If you're buying a duplex, $538,000, $650,000. Triplex and fourplexes are considerably more. These change depending on the county that you live in, so keep in mind. There are different types of FHA loans. First one is a purchase loan, which is mainly what I'm talking about today, which is financing the primary residence where you will be living, 3.5% down payment with a 580 score, and gifts are permitted. You can also buy a house that needs some improvements, which is called a 203K home improvement loan. You can use that to purchase a loan that need a little tender loving care. And this loan is closed on time, just like a regular purchase loan, and there will be an escrow account set up so that they will disperse the repair payments as those get completed. An energy efficient mortgage is similar to a 203K, but this is to cover energy efficient enhancements to the home, so like windows, insulation, solar, stuff like that. There is an energy assessment that must be completed, including the windows, insulation, solar, and wind technologies that need to be looked at as you go through the process. A reverse mortgage helps borrowers over 62 years old to purchase a home and access their equity, and they still have to qualify for the property for the mortgage as if they're making payments, although most reverse mortgages do not require payments once you close on the deal. So borrowers can skip the payments or receive some of the money from their equity instead of making payments. So if you're over 62 years old, you're ready to retire, you have a home that's been paid off or is very low in loan, that you have a loan that's small in value, then you can finance up to 80% of the property and get some of that money out and have access to that, so that you can use that equity while you are still living. Give whatever you need to your family, to your kids, send them to school, whatever you need to do while not making payments on that property. There are other restrictions and guidelines on reverse mortgages. They're not as simple as they sound. You do have to qualify for them, have to have the ability to repay and qualify for the payment through your income and credit and all of that. So if you have any questions on any of these type of programs, please make sure to ask your loan officer or myself once we meet. So I set up a online calendar where you can schedule an appointment if you want to get rid of your doubts, find out where you stand exactly. We can have a meeting. We can have a phone call if you like, and then we can have a virtual meeting where we can meet over the internet and just kind of discuss your options and where you want to go. I have a website set up at theflashlender.com. It offers a lot more information, and as well as a calendly appointment calendar as shown here on the page. And that is the end of this short video. Please make sure you check my YouTube channel so you can take a look at other programs that are available that might help you qualify, as well as some instructions on your credit, mortgage insurance, and any other questions you might have. Again, my name is RJ Silva, the Flash Lender. Thank you for watching. Have a great day.